Hello everyone and welcome back to the sessions on financial reporting, and this is continuation of the topic financial statement analysis. And in the previous class we have discussed the initial part of this chapter, and we have planned that one by one we will be taking up all the case studies in this topic. So let's begin with the first case. I'll read out the case for you. Please pay attention over here. Case study 1. It says on April 1, 2021, Star Limited has advanced a housing loan of rupees 15 lakhs to one of its employees at interest rate of 6% per annum, which is repayable in 5 equal installments along with interest at each year end. Guys, first thing what you need to do is, whenever you are reading any case study or any question, you should always understand that what is happening over there. So the employer has lent to employee. The nature of the loan is basically housing loan, and this loan is offered as a principal amount 15 lakhs at 6% per annum interest, and it says this line, most important, repayable in 5 annual installment along with interest at each year end. Now see, if the question says, or if the case study says 5 equal installments including interest, means you follow the concept of annuity where same amounts will be repaid every year. You know what we do in case of EMIs or EAIs, equated yearly installment, EYI or EAI, that is equated annual installment, just like EMI, equated monthly installment. So basically it is not the case of EAI over here. Why? Because the amount of installments are not including interest. It says 5 equal annual installments along with interest at each year end. How do you interpret along with interest? So it will be 15 lakhs of loan which will be repaid over 5 years in equal amounts. That means that equal amounts what they are targeting is the principal repayment. So if you divide 15 lakhs by 5 years, annual repayment of principal will be 3 lakhs every year. Thereafter, along with that, the employee is also supposed to pay 6% per annum interest. Okay, fine. So it will be 3 lakhs of principal repayment every year, and on the outstanding balance interest at the rate of 6% per annum. So how would you compute the cash flows arising from this particular lending? The cash flows that will arise from this particular lending, it will be 3 lakhs plus interest of each year. So in the first year it will be 6% interest on the entire outstanding balance of 15 lakhs, 6% of 15 lakhs plus principal repayment of 3 lakhs. So 6% of 15 lakhs will be what? 90,000. That 90,000 plus the principal repayment amount, that is 3 lakhs. 3 lakhs plus 90,000. 3,90,000 will be the cash flow in the first year. Second year, the outstanding principal balance got reduced by 3 lakhs. So the closing balance in the first year will be 12 lakhs. In the second year, that becomes the opening balance, and the employee will be paying interest at 6% on that 12 lakhs. So it is 6% of 12 lakhs, that would be what? 72,000 plus 3 lakhs of principal repayment. So 3,72,000 will be the cash flow. As and when the years are passing by, the amount which is towards the interest component will get reduced because the balance is getting reduced. Fine. What is further informed? Employee is not required to give any specific performance against this benefit. That means the company is not asking employee any additional activity to be performed against this benefit. Now why it is called as a benefit? Because this line clarifies the market rate of similar loan for housing finance by banks is 10% per annum. Who is generally giving housing finance? Banks, right? Banks and other lending institutions. If they are charging 10% per annum means this is the effective interest rate as per the interpretation of Ind AS 109. One thing is very clear, you have offered a loan. So here loan becomes an asset, that is basically a loans and advances to the employee, that is a financial asset for the employer entity. And what has happened? This financial asset will have to be valued as per the requirements of Ind AS 109. In this case, one thing is very clear, that the interest which is contracted between employer and employee is substantially lower than the prevailing interest rate in the market. Now see, if prevailing interest rate in the market is 10% and the employer is giving loan to employee at 9.8%, we may call it competitive interest rate, correct? Because that way, if one bank is giving interest offer of 10%, another bank may charge 10.3%, yet another bank may charge 9.8%. Those difference of interest rates is basically competitive nature of business. But if someone is charging 10% and you are charging 6%, it is definitely a reduced interest rate, and we cannot consider in this example 6% as effective interest rate. So as per the requirements of Ind AS 109, and once I have read this one paragraph over here, you should be clear with one thing definitely. What is that one thing? That employer has offered loan to the employee at reduced interest rate. Now let us read further. It says the accountant of the company has recognized a staff loan in the balance sheet equivalent to the amount of housing loan disbursed, that is rupees 15 lakhs. The moment I read this line, I don't know what is informed further, but one thing is definite, that it is an error, because all your cash flows will be computed based on the contracted interest rate of 6% per annum, but the effective interest rate is higher than that. If the effective interest rate is higher than that, what will happen? The present value of the loan amount is definitely going to be lower than the actual amount disbursed, because logic is simple. You are computing interest at 6% to arrive at the future cash flows, and when you arrive at the future cash flows with 6% interest considered, and then you are discounting those cash flows at effective interest rate of 10% per annum, obviously the present value will be substantially lower than the amount of loan disbursed. That means the recognition of the loan is not at the amount which is required by Ind AS 109, and there is a flaw in the initial measurement and recognition itself. Let us read further. The interest income for the year is recognized in the or at the contracted rate in the statement of profit loss by company, that is 90,000, that is 6% of 15 lakhs. Guys, another error what I can find out is, see, your interest income and interest expense must be recognized on regular basis. At which rate? Using the effective interest rate and following the amortized cost method suggested by Ind AS 109. So neither they followed amortized cost method for the initial recognition, because initial recognition itself is not appropriate, and when they are not using effective interest rate for recognition of interest income over here, obviously this is not what is in line with Ind AS 109. Two errors I could find already over here. Further, analyze whether the above accounting treatment made by the accountant is in compliance with the relevant Ind AS. Definitely not. Before even they ask, we have already traced out that. If not, advise the correct treatment of housing loan, interest and other expenses in the financial statement of Star Limited for the year ended 2021-22, along with workings applicable Ind AS references you have to provide. You are required to explain how housing loan should be reflected in the Ind AS compliant balance sheet of Star Limited as on 31st March 2022. Now look at one thing, guys. In this entire case, not a pinch of involvement of any other standard. Yes, there will be some possibility of employee benefit expense that may emerge, but that is not emerging because of the employee benefit standard. It is emerging because of application of Ind AS 109 itself. So, important thing that you need to understand, we are very clear about what is the problem in the case and how to solve it. So, before we look into the answer suggested by ICAI for this case study, you should be mentally clear, because see, I told you yesterday in the previous class that when we are reading a case, don't just watch the case study discussion like you are watching a series, correct? It is not something that you have to watch and listen and just understand. When we are reading a case, your involvement in that case has to be there, then and then only it makes sense to deal with this kind of case study. Otherwise, it is just watching video and just finishing it off. So get involved in this discussion, whether you are attending the live class or you are watching the recorded video. I just want your involvement over here. So how would you deal with this? You identify that you have given a loan which you have given gives you right to recover interest and principal. That means you have a right to receive cash. You have the right to receive cash in the future. It is one of the characteristic which is included in the definition of financial asset. That means we are talking about a financial asset. The moment we say that for Star Limited this is going to be financial asset, we will have to now identify which category of financial asset. Now we have three categories of financial asset. Financial asset carried at fair value through profit or loss, financial asset carried at fair value through other comprehensive income, and financial asset carried at amortized cost. Now how do you classify which financial asset will this be? Here you have to apply the classification principle. The financial asset classification is based on two fundamental grounds. One, it is the test on the asset, which test whether it is having a contractual cash flow characteristic or not. What is contractual cash flow characteristic? There are definite amounts to be paid by the counterparty. That means the Star Limited company is going to receive definite amounts at definite dates. Dates are given, amounts are defined. So you have definite amount of cash flows arising at definite date, and the cash flows that are arising to the entity are representing only two components. One is the interest on the principal and another one is the repayment of the principal itself. So when these two conditions are fulfilled, means the instrument which is a financial asset for Star Limited is having contractual cash flow characteristic. Now, what is the business model of the entity that you have to look into? Do you think the objective, the intention of Star Limited will be to sell off this financial asset? No. The moment you are not going to sell it off, what is its fair value? You are not concerned with that. Nobody is going to buy out this in any financial market as such. If you want to shed away this asset from your balance sheet, you have to approach another financial institution or maybe a bank to take away this financial asset from you. And boss, who is going to compromise with interest rate of 6% where the prevailing rate in the market is 10%? Nobody is going to buy this financial asset unless you sell it at a low price. So all hints are clear that the intent as well as ability of Star Limited is to hold the financial assets and receive only and only the contractual cash flows. So two things are very clear, that the instrument, the asset has contractual cash flow characteristic, and the business model of Star Limited is to receive only and only those contractual cash flows, not to realize money by sale of this asset. So both the characteristics, both the conditions are highlighting one thing, that this asset must be classified in which category? Amortized cost category. See guys, when you are building an approach to think in your exam, you have to see how I started. I first understood that if there is anything that has to come within the scope of Ind AS 109, it has to be either a financial asset or a financial liability or an equity instrument. The given case highlights existence of a financial asset because it fulfills one of the points of definition of financial asset. The moment I say that this is a financial asset, next thing comes which class of financial asset this is. So we defined, just now we defined that it will be classified in which category? Amortized cost category. Means this is a financial asset sorry, this is a financial asset which is to be carried over at amortized cost. Following what? Following effective interest rate. Now next thing comes initial recognition and measurement. Now how do we go for initial recognition and measurement for amortized cost category? So you know one thing, if it is FVTPL, that is fair value through profit or loss, you have to record it at fair value. So this is not fair value through profit or loss. If it is short term receivables, you have to record it at the transaction amount. This is not even short term receivable, it is a 5-year term loan, correct? That means this is the third category. That means any other category. In any other category, it will be fair value plus initial transaction cost. Now there is no fair value over here. So we will have to arrive at the fair value. Now how would you arrive at the fair value? Identify all the cash flows towards interest, that is the contracted interest, and the principal repayment. Club those two amounts, you will get cash flow in year 1, year 2, year 3, year 4, year 5. Then identify what is the effective interest rate, apply that effective interest rate, find the present value of this obligation. The present value of this obligation is the value of your asset. If there is any difference in the amount actually disbursed and the present value of this loan asset, you have to make some adjustment towards that. It is not your asset in any case. That difference, if any, if it arises, it is not your asset. You have to treat it differently. Then, if this much is clear, then what you should do, what error they have committed, we will show the rectification of that. That's the second thing. But what to be done or what should be done on a correct basis, that is what your focus point should be. So you recognize the loan asset at its present value, keep applying the interest at effective interest rate of 10%, but you actually receive the interest at contract payment basis and the principal repayment every year. If all your calculations are made till end of 5th year, you know we make a table for amortized cost calculation. Your table at the end will show outstanding balance as 0. So many times we have learned how to deal with this, whether it is a case of asset or a case of liability. We know how to start with that present value, whichever rate you have applied as discounting rate. If you keep adding interest at that same rate, obviously at the end on termination the balance will become 0. That is what we call as application of amortized cost method. So guys, when you are crystal clear about what should be done, then look into what they have done. There is an error, you need to rectify that, correct? So are we now ready to look into what ICAI is suggesting as answer over here? Let us read it out. See guys, one more thing. When they are giving this as solution and writing all this description, boss, you cannot skip this. Don't just show the calculation, consider that as end of the game. They will not accept your answer. Then what happens? After the exam is over, you will be under impression that you have done everything correctly, still you did not get marks. It is because you have to analyze a case as a case, and that is where what is the expectation of the examiner. Let us try to understand what they have written over here as answer suggested by them. the accounting treatment made by accountant is not in compliance with Ind AS 109, that is financial instruments. As per Ind AS 109, at initial recognition, entity shall measure financial asset or financial liability at its fair value. The fair value of financial instrument at initial recognition is normally the transaction price, that is fair value of the consideration given or received. After initial recognition, an entity shall measure the financial asset either at amortized cost or at fair value through profit or loss or fair value through other comprehensive income. Guys, as I suggested, they have first identified that there is existence of a financial asset, though I am not really very happy with the way they have structured the solution. If you allow me to answer this question, my approach to answer this question will be little more specific. I would write the first paragraph. Of course, I will mention all these points, but I will mention that there is existence of financial asset, because as per this loan contract, the contract is giving Star Limited, that is the employer entity, the right to receive cash flows. The moment you have right to receive cash flows, there is existence of financial asset. Then comes the next paragraph about the classification of that financial asset. Let me read further what they have given. Here the loan given to employees is not at market rate, hence the fair value of the loan will not be equal to its proceeds. As per Ind AS 109, a financial instrument is initially measured and recorded in the books at its fair value. Further, interest income to be recognized in the statement of profit and loss will be the finance income recognized at effective rate of 10% and not the contracted interest rate of 6%. So I am very happy with the way they have drafted this paragraph. But one thing that I am not okay with, after writing this line, they should have used those two criteria. That is, what two criteria? The existence of contractual cash flow characteristic, fulfillment of that condition, and the business model of Star Limited not to sell this asset but to recover only the contractual cash flows. Further, for measuring the fair value, the present value of the loan at initial recognition at similar rate, that is 10%, to discount the cash flows, and the fair value of loan will be as follows. Now look at this. Outstanding loan and principal repayment every year is 3 lakhs. So I have already explained you this part of the calculation, correct? That on 15 lakhs, you consider annual repayment of principal as 3 lakhs and interest on entire 15 lakhs in the first year. Then because 3 lakhs of principal has been repaid, second year opening balance becomes 12 lakhs, and on that 12 lakhs you apply 6%, the interest amount will be 72,000. So this is the amount paid towards principal. This is the amount paid towards interest. So your cash flow every year is sorted. Now you apply present value factors at 10% discounting rate and compute the present value. The present value of that loan asset will be the fair value of the loan. So this whole working, I'm absolutely okay with the way they have presented. That is the right thing. So I'm sure you are clear up to this part. So couple of suggestions that I have offered, you should consider those additional inclusions in your answer. Other than that, what ICAI study material is suggesting, you can just follow that. As per Ind AS 19 employee, now because I told you there will be a component of Ind AS 19 getting involved, okay, but the main leading standard in this whole case is Ind AS 109. All forms of consideration given by an entity in exchange for services rendered by employee for or for termination of employment, difference of loan proceeds and present value of the loan will be treated as prepaid employee cost, irrespective of the fact that employee is not required to give any specific performance against that benefit. Boss, that line that they mentioned in the case study, that for this purpose the employee is not required to give that loan, then why Star Limited gave loan only to their employees? Nikhil sir also needs loan, correct? So please give me loan, Star Limited. If you are willing to offer loan to anyone and everyone, you can give me loan, but you did not give loan to me. You have given the loan specifically to someone who is your employee. That means you are giving some additional benefit to your employee. It has to be Any difference if arising, it has to be part of the employee benefit expense for Star Limited. Fine. Difference of loan proceeds, we have read that point. This is because employee is required to be in service of the company to continue to avail the benefit of concessional rate of interest. Practically, once the employee leaves the organization, they have to repay the out. Suppose after first year, when first year the employee was supposed to make interest payment of 90,000 and the principal repayment of 3 lakhs, the closing balance of outstanding is 12 lakhs. Suppose that time employee decides that I'm fed up of this job, let me leave it. So what will the employer demand? That okay, fine, employee, you are leaving the job, you leave, but whatever is your outstanding balance, you please clear that. That outstanding balance the employee has to clear. That means to avail that benefit, what employee is getting as concessional interest, the employee has to remain in service. That means the benefit is not vested, it will be vested year on year basis. Imagine guys, if the benefit would have been vested, what would have happened? The employee would have been given a free pass that whether you remain in employment or not, this loan is given to you, you can repay over 5 years time and at 6% per annum interest. But that was not the case. The employee has to remain employee to get this benefit. That means the benefit was not vested. The benefit will be vested over the period of employment of next 5 years. Fine. Practically, once the employee leaves the organization, they have to repay the outstanding and fine. Hence, it is an employee benefit given to the employee. This is deemed employee cost. How much is the deemed employee cost? Look at this point guys. 15 lakhs is the amount of loan disbursed and this is the present value of that loan asset. Difference between these two, 1,45,398 should be treated as the employee cost. That means employee benefit expense given in advance to your employee. Now, look at this. You recognize the initial amount at the present value. Consider 10%. Correct? 10% is your interest income, but the amount that you have received is 3,90,000. So opening balance plus interest accrued at effective rate of 10% minus the amount already received, you arrive at closing balance. Keep doing the same thing at the end. Difference of 471 is due to approximation. This is one of the big stupidity I find in ICAI materials. I still don't understand why these people make rounding of difference and then write this note. If I am making this calculation, not a paisa of rounding of difference may arise. If difference has to be to the nearest rupee, then I would simply suggest you all, and I have always been, if you have solved all the questions from my textbook, you know what I do? I look into the cash flow amounts. Look at these cash flows. These are 6-digit amounts, and for any difference not to arise in 6-digit figures, if you don't want any rounding of difference, because you are going to round off the calculation to the nearest rupee, if you want a zero difference in your calculations, when you are computing these present value factors, no, that time don't take 3 places after decimal, take 6 places after decimal. It is such a logical and reasonable thing, but I do not understand why they are sticking to follow this shortcut thing and then are okay with this difference in your accounting records. In real life, if I am maintaining my accounting records, I am so particular, I will not let a balance of even or difference of even 1 rupee arise because of rounding of differences. Yes, when difference is practically that small amount, that is immaterial. So what they consider is that 471 is an immaterial difference. Materiality is the ground where they are taking a safeguard defense that okay, on grounds of materiality, we are okay accepting this kind of difference. I would say this is a free pass to a student, correct? That okay, you take 3 places after decimal, 4 places after decimal, or if you are Nikhil sir student and you are taking 6 places after decimal, everything we will accept. This is what I call as a free pass. In fact, institute is giving you liberty that whatever answers you are giving in respect of that, to the extent your calculations don't go wrong, we will accept it anyway. So this amortized cost calculation, we have learnt it so many times. important thing is, look at this. From the bank, there was a disbursement of 15 lakhs. Loan to employee, which is your asset, will be considered as your financial asset. This is a prepayment of your employee benefit. This is also your financial asset, but you are not going to recover this in cash, correct? You are not going to recover this in cash. It is, sorry, it is basically a prepaid kind of expense over a period of 5 years. So it is your asset, but you are not going to recover in cash. This asset cannot be having same characteristic as this asset. Treatment of this will be as per the requirements of Ind AS 109, and treatment of this amount will be as per the requirement of Ind AS 19. Now look at this. Bank account debit, when you are receiving that 3,90,000, this much is towards your finance income, which is 10% of your opening balance of loan, and the balance is your recovery of the loan, correct? Thereafter, whatever was the initial employee benefit cost recognized, this amount, this is a kind of prepaid expense, right? It will appear in your balance sheet to the extent it is unamortized. You have to amortize this over a period of 5 years. Every year, 1/5 of that, if you are amortizing, this much amount is considered as employee benefit cost. So your prepaid amount which was included in the balance sheet, from that 1/5 every year you are charging to P&L in the name of employee benefit cost of that year. In other words, the treatment of this amount is to spread over the period of 5 years on static basis, that is on straight line basis. And then look at your balance sheet presentation, extracts of balance sheet. Now loan to employee, how would you consider loan to employee? This is the balance sheet extract on 31st March 22. So basically they have taken this amount, okay, that is 11 lakh. From where did they get this amount? It is the second year, right? So this was the opening balance in the second year, okay. They have added this interest, subtracted this repayment, and this is the closing balance. That is what they are reflecting over here. Same thing reflected. So this is the opening balance plus the interest accrual minus the recovery. This is that amount. Prepaid employee cost, to the extent it is not amortized, and then in your financial asset, the loan to employee will be this amount, and other current assets. So basically you are considering financial asset under two categories, non-current and current. So whatever be the amount which is going to be recovered within the next year will become your current asset, and what is your amount which is not to be recovered within 1 year becomes non-current. So it is financial asset, but financial asset will be itself split into two categories, that is current and non-current. What you are recovering within next 12 months, that is the current amount, and the balance is recovered. I will repeat it again. The amount which you are recovering in the next 12 months will be the current asset, and the amount that you are going to recover other than the next immediate 12 months will be non-current. So generally students ask me, sir, why prepaid expense is amortized equally? Can't we write off prepaid expenses on the basis of discounted value? No. I'll give you the simple reason to that is, it is the application of not Ind AS 109. Please consider this point very clearly. This applies to leases as well as it applies to your employee benefit accounting standard. When you are considering any kind of employee benefit expense, you tell me one thing, how much benefit you give to your employee? You tell me, how much benefit you give to your employee? This much benefit? Is it loan? No, it is not loan. That means interest rate cannot come over here. Understand this. Interest rate cannot come over here because this is not loan. This is an advance benefit given. For how many years? 5 years. Against this, what you are going to receive? Services from that employee. Now tell me, the degree of service of that employee, is it going to be same type of service or not? Same type of service. Employee is going to do the same. Employee is going to perform the same type of duty. So what benefit I get from that employee in the first year? same employee, same activity in the second year, same employee, same activity in the third year, benefit what I am deriving from that employee will be static. So logically, cost should match the benefit, right? Benefit is in straight line, cost also should be amortized on a straight line basis. So students who have this doubt in their mind should logically understand that why are we following straight line thing over there. Anything which is coming in the scope of financial asset or financial liability, they will have application of effective interest rate. But whatever is not part of financial asset and liability, that will not be under the scope of interest calculation, and they will be treated just like any other cost benefit principle. So you have to match cost with benefits. Basis of your benefit you identify, if it is straight line, you amortize the cost also on a straight line basis. I'm sure whoever has asked that doubt, I have clarified that point and you should not be having any trouble to that. So we have given extracts of balance sheet, and yeah. Now look at this. Deferred tax on temporary difference arising on above mentioned account should be recognized. However, in absence of any tax rate in the question, guys, one thing in the question, if I would have just mentioned one point, what is that one point? Tax rate. Immediately deferred tax calculation will arise. How? Let me explain that to you. Look at one thing. This is the amount of money that you actually paid. Income tax records will consider loan asset as 15 lakhs. Income tax law does not follow Ind AS 109. They follow what is your actual outflow from your bank. You gave loan of 15 lakhs, but you are recognizing a loan asset of 13,54,602. This is a temporary difference. This is not a permanent difference. This is a temporary difference. You are showing your assets at a lower value, correct? Impact of this. Now you can simply see that whether this is a taxable temporary difference or deductible temporary difference, you have learnt the standard, correct? You have learnt Ind AS 12. Apply that, think over it, and 30% of that will be recognized as a deferred tax. But because of absence of tax rate in the question, the solution says we have ignored this. When I was explaining you this entire case study, I did not even mention about this. But look at a fantastic point given by ICAI. They have considered something which even I did not mention. Because I did not find any tax rate, I did not talk about implication of that. They have mentioned that that could also be considered in the given case, because in reality, in real life, if this case is arising, you cannot ignore deferred tax arising because of these temporary differences. So that is end of case study 1.